Hello there, this is Bruce at Fleet Capital Management. It is Monday, the 13th day of July 2026. I've gotten a number of questions on this upgrade we're making to all portfolios for Group 1, 2, and 3, and also how we will be using stop management, how to choose which portfolio is best for you. So I just decided to make a video, and hopefully this will address a number of questions. And if not, obviously give me a call, shoot me an email, and we'll talk about that. Um, so I sent you an email asking you to choose between risk and reward, whether you would like one or all of your portfolios in Group 1, 2, or 3. Group 1, the objective is to maximize returns. I expect the volatility to be greater than the S&P 500, probably not by a lot, but I do expect it to be greater than the S&P 500. So the primary focus of this portfolio is to maximize returns with a lesser focus on the risk management. But let understand that I'm always looking at the market and risk management, and we'll come back to that. Group 2 is looking to kind of balance risk and return. I expect that the volatility will be a little less than the S&P 500, but still generate significantly higher returns than the S&P 500. Group 3, your number one priority is downside protection. I expect this portfolio to have very, very low amount of volatility. When you are making these choices, I believe your focus should be on volatility and risk rather than return. Everybody wants good returns. So let's just set that aside for a second. Look at your comfort level with volatility. If you want just to absolutely try to maximize your returns and you don't care about volatility, choose Group 1. If you now Group 2 as well as Group 1 are being designed to outperform the S&P 500. But Group 1 will, like I said, will have a higher rate of return with higher volatility. Group 2 will have a lesser rate of return than Group 1 with lower volatility. Group 3, you're really seeking downside protection. Okay? A couple other things. Group 1 and 2 may hold approximately 5% in BALT. BALT is a very low risk investment. This is being used as a placeholder, just always watching and scanning the markets for opportunities. For instance, I've made a lot of money trading Bitcoin. It's been down dramatically this year, but there will come a time probably where that reverses. It kind of looks like it's trying to do that now. And when Bitcoin shows a lot of new money flow coming into it, it runs fast and we can make money on that. We can make money on gold. We can make money on a lot of different securities that I'm calling special opportunities. So we'll leave about 5% in BALT, still earning a rate of return. So we can look for these opportunities, these shorter term opportunities. Any opportunistic investment will use normal stop management. I'm going to put a pin in that. I'm going to come back to that. All group portfolios will try to minimize short-term capital gains. Now, probably 80% of the portfolios that I manage, the accounts that I manage, are tax deferred. They're retirement accounts of some sort, Roth, IRA, 401k, something like that. But I also need to be very aware of taxes for my fully taxable accounts and clients. So the objective is that all investments, all portfolios, we will try to minimize short-term capital gains. Now, I can't guarantee that because let's say we're in these portfolios and 3 months from now, something really bad happens and it looks like we're going into a bear market. Well, I'm going to protect us from a bear market, so that wouldn't yet be long-term capital gains. I don't expect that to happen, but I want you to know this is my objective. Okay. Group 1 and Group 2 portfolios will employ stop management. This is important only When the market or the individual investment shows bear market potential, we are not going to use stop management for the most part for the normal, sometimes gut-wrenching swings in the market. We are not going to do that because when we do that, we protect downside, we miss upside. We're going to extend that out a little bit more. We're going to watch every individual investment, but we're going to look for more uh, macro swings, not micro swings, if that makes sense. So we're changing our stop management a little bit. We're going to ride through. Now, that doesn't mean we're not paying attention to it. And I've designed these portfolios like Group 2 to have less volatility. And hopefully that won't even be an issue. So, but I wanted to point that out. Lastly, here, this is not a buy it and forget it system. Investments will be added or replaced as appropriate. I am constantly doing research on investments, and if I find an investment that would enhance the returns and or reduce the downside, the volatility of any of these groups of investments, I will make those changes. Okay, a couple more things. Let's go over here. The market's doing poorly today because it looks like we're back at war with Iran, which is whatever, kind of insane. But let me show you this. So we have three different portfolios here. This is one of the research systems I'm using. And I'm not going to spend a lot of time, I promise, but let me just show you something. Group 1 portfolio, which is right here, over the last year, has generated 42.99% rate of return, S&P 21.02. Well, most people's brains will say, oh, I want the 43%, but can you handle that volatility? That's why volatility is the most important thing. Here's the returns per period. You can see over the last 12 months, the S&P is up 21, this portfolio up 43. Here's all the individual investments. This one up here is cash. It's a treasury bill. But pretty much every investment in this portfolio, every single one alone would have outperformed the S&P 500. Combined, they did a phenomenal job. If you look to 3 years, there's a lot of blanks because some of these investments haven't been around for a full 3 years, but over 3 years, the S&P 19.5, look at the investments that do have numerical values to quote, every one of them outperformed. So my point is, and the same thing 5 years, is what I'm seeing with 1 year, I would expect for 3 years and 5 years. More importantly, I really want you to focus on this. These are monthly returns over the last year. This is just group 1. In March, it was down 4%. In July, this month, we're not finished, we're halfway through, down 2%. Last March, down 1.5%. Let me see if there's any others in here. No. So my point is there are going to be swings. April was up 13%, but March it was down 4.5%. We're going to allow those swings to happen. This is what I'm talking about with volatility. The other thing is beta. The S&P 500 has a beta of 1.00. So any number higher than that, which this is a little bit higher than that, suggests that it will be more volatile. It'll swing higher and swing lower than the market. Okay. All of the risk metrics are in the green. They're all really strong. So I'm paying attention to the risk of each investment that makes up the portfolio. And I can even look down here. We've got a better Sharpe ratio, a better Sortino ratio, and on and on and on. So that's group 1. Let me quickly show you group 2 here. So here's group 2 portfolio. This is the one that most of you are responding. You want most of your money in, and I probably agree with that. And if we look back over a year, it's had, the other one had like 40 something percent. This was 33.26. It still significantly outperformed the S&P, but it did it with less risk. If I scroll down first to, let me find my beta. Um, right here, instead of having a beta above one, we've got a beta below one. So that suggests that it has lesser swings to the upside and to the downside, and it generates a little lower rate of return. It also has negative months in there. I think Group One in March was down 4.5%. This was down 3.7%. But there are going to be, I really want to point out these negative months. Here was three negative months in a row in 2023. Here was a down for December of 2025. But here are the annual totals over here. They were really strong. So uh, that's what I need you to focus on, if you will, is the level of volatility. You can see also in Group 2, the S&P over the last year is up 21.02, aside from cash, of course. Every single investment chosen for this portfolio outperformed. If you look at 3 years, every single investment in this portfolio outperformed. And they are balanced in that I have value momentum, I have growth momentum, I have international low volatility, high dividend, I have free cash flow types of stocks. I have world leaders, another global portfolio. And of course, I have technology. So the portfolio has been constructed very deliberately to give us that the best return we can get for the lowest amount of risk. Finally, let me go to Group 3. Group 3 portfolio, and what I want you to really focus on this one is this chart. This is just a 6-month chart, okay? The green is the green is the portfolio. The gold is the S&P 500. This was the whole Liberation Day, I think it was. But look at how smooth the green line. It went down just a little bit, came right back up, and it continues to grow. This is just 6 months. So if you don't want the swings of the market, but you still want to beat CDs, treasuries, things that are risk-free, this group is perfect. Again, 337 is just for 6 months. So if you double that, if we assume that that would have been the same, since how consistent the portfolio is, that would be six, almost 7%. So here's the bottom line for these portfolios, in my opinion. In my opinion, you're looking for returns in Group 1 and Group 2 to outperform the S&P. That is a reasonable expectation over time to outperform the S&P 500. Group 1 should, or it has the potential to outperform it more than Group 2. But Group 2 still outperformed it pretty fantastic. I'll show you something that hopefully I won't regret showing you, but let me do something for you here. Let me change my benchmark from the S&P to the Qs. And I'm going to go back to Group 2. And now, instead of comparing to the S&P, I'm going to compare to the NASDAQ, and I'm going to go back a year. Okay. Oh, it didn't update. Why didn't it update to the NASDAQ? Bear with me one more sec. Let's see if I made a mistake here. Settings, benchmark. Aha, I didn't update it. Let's go back here. QQQ, that was user error. Trying to go too quickly for your video. Now let's go back to Group 2. I'm not even doing Group 1, I'm doing Group 2, and we're going to go back a year. Okay, there we are. The green line is the portfolio, 33.26. The gold line is the NASDAQ, 31.54. So not only in this past year did it outperform, the portfolio outperform the S&P, but it also outperformed the NASDAQ. And of course, since the Group 1 portfolio is even higher risk, it performed even better than this. Now, I don't want you to ever think that we're always comparing ourselves to the NASDAQ, because we're not. You'll get hurt if you do that. The world of investment management looks at the S&P 500 as the market, not the NASDAQ. But the NASDAQ's done incredibly well recently, and that's why this comparison is so good. So I hope this helps. I hope um, this makes sense. So if you have already sent in your portfolio group choices, you can always change. And after this video, if you've decided, hey, I want to make a change, fine, make a change. If you haven't given me your responses, which I do need very soon, then I hope this video helps you with that decision-making process. If you want to talk one-on-one, shoot me an email or hop on the calendar and we'll do a screen share and talk about your portfolios and your risk tolerance and all of that. So again, I hope this helped. Let me get back to working on the market and I will talk to you a little bit later. Bye-bye.